Hello everyone, I'm Christopher Tan and welcome to Providence Money Wisdom, an original podcast inspired by my book Money Wisdom, Simple Truths for Financial Wellness. In this podcast, I'll be sharing simple financial truths to guide you in navigating through the minefields of misinformation and false promises in order to achieve financial security and peace of mind. The best way to get investment returns. I've illustrated how my firm plans for the 59-year-old David Tan in the previous episode. We will use the same illustration in this episode to elaborate more on investments for retirement. Indeed, the way your portfolios are invested should be based on these key principles. For portfolios that present higher expected returns and risk, you will need a longer time horizon. In my 2 decades of investment journey, I've come to observe that the best way to get these returns is to stay invested and not time the markets. As such, when my team at Provident invests clients' assets, we do not change portfolio allocations in the short term just to respond to market news like Brexit or US elections. These principle-based decisions have served our portfolios very well. It is hence essential to find the right instruments to act out this philosophy that we hold. I've presented the reasons why I propose using low-cost index funds, such as the BlackRock funds. I have stressed earlier that most active managers cannot beat the markets, and for the rare ones who do, it is highly improbable they can do so all of the time. Many simply lack the prerequisite skills to beat the respective benchmarks over the long run, and even if they do, the high fees charged will definitely eat into the returns for investors, resulting in negative or underperformance. Another type of funds, a hybrid of managed and index that my firm actively use, is the Dimensional Fund Advisors Evidence-Based Funds, or DFA in short. So let's talk about evidence-based. The uniqueness of DFA is that it really straddles between actively managed funds and index funds. Like index funds, it broadly diversifies and does not time the market. This is because it believes that price is efficient, and as such, it does not trade in and out frequently, which often results in incurrence of high cost. One of its funds, the Global Core Equity Fund, invests into more than 7,000 to 8,000 companies. In addition, like actively managed funds, DFA tilts part of their portfolios towards securities that give higher expected returns. The difference is that DFA only picks those that show evidence of higher expected returns that are persistent across time periods, pervasive across markets, and sensible and cost-effective to capture. These evidence are based on academic research by scholars in the likes of Nobel laureate Eugene Farmer, Kenneth French, and many others. Many of them act as consultants, board directors, or investment policy committee members to or for DFA. The next thing about DFA is that it is of low cost. It is one thing to be able to discover great investment ideas. It is quite another to be able to implement them effectively and efficiently while keeping costs low. DFA achieve, the returns by first avoiding the need to buy and sell a security because of price targets. It keeps the security as long as it continues to meet its criteria. Even if it needs to buy or sell, considering it invests in thousands of securities, it has the luxury of choices. Thus, it does not have to chase down any single security. Moreover, because of its size, which is now almost close to 600 billion, it has enormous economies of scale. On average, the annual management fee for DFA funds is anything between 0.3 to 0.4% per annum, similar to an index fund. Compare this to the average annual management fee for other equity-based unit trusts in Singapore, well, which may charge a whopping 1.65 or even 1.8, 1.9%, which is very expensive cost-wise. Well, the important thing about all these cost savings is that it must translate to actual performance. Because all said, at the end of the day, it all boils down to performance. My firm has chosen DFA for our retiree clients simply because it has performed well. It has consistently tracked close to the index over the long term, and it is what we want it to do. Occasionally, DFA may do slightly better than index, and if it happens, it is a bonus for the portfolios. Earlier in the episode, I have reiterated the 5-pronged risk retirees face: longevity risk, inflation risk, healthcare risk, investment risk, and finally, overspending risk. Perhaps the greatest risk that retirees face is the risk of not having a second chance again. This is also my greatest fear for retirees. Because of their advanced age, in the event of mismanagement of retirement monies and no more earning an income or even poor health, retirees might not be able to accumulate sufficient sums for their retirement again. While the RetireWell methodology is developed to mitigate all these risks via the bucket approach of financial planning, for it to work, we need to use appropriate financial instruments that are evidence-based, boast good performance track records, and are adequately low cost to give retirees a reliable income stream. So, back to the case of David Tan. Considering his portfolios were executed using low-cost instruments such as ETFs, index funds, or evidence-based investment funds, coupled with the principle my firm holds that we make no predictions or changes to asset allocation or portfolios in response to market news or historical trends. That is, we do not time the markets. How does our investing approach work for the retiree client? If you had been investing in 2016, you would know that throughout those 12 months, many analysts through various media channels had made many calls to move out of equities. They had predicted it to be a year when stock markets would crash. Certainly, they had good reasons for it. 2016 started with the continuation of sell-off in the emerging markets since 2015 due to fears of slowing growth in Asia. S&P 500 was also at all-time high at the beginning of the year. Then, there were the fears over Brexit and the results of the US elections. But we stuck on to our philosophy, and these were the results we achieved. For Bucket 2, which the portfolio expected returns is 3.5% per year, the actual return in 2016 was about 3.1%. For Bucket 3, the portfolio expected returns is 5.5% per year. The actual returns that we achieved in 2016 was 6.99% for Bucket 3. And for Bucket 4 to Bucket 6, which the expected return is 6.5% per year, the actual return that we achieved for the retiree is 7.59%. By ignoring calls to time the markets, as well as using low-cost instruments, we simply rebalance the portfolios when necessary. Well, you will realize that if you had heeded those market timing calls, well, you would have been completely wrong and missed the returns which I've just shared with you, what we have achieved for our retiree clients. While this way of investing calls for discipline and courage to ignore noise, it allows our retiree clients to reap the returns as well as to avoid the stress of having to guess where the markets would be. In truth, as it has been consistently shown, even professionals get it wrong most of the time. Thank you for tuning in to Providence Money Wisdom. I will be back soon with the next episode. For more information on my book or Providence services, kindly visit provident.com. I'll see you the next time. All analysis, views or opinions from interviews, recommendations and other information broadcasted, podcasted or published herein are provided for general information purposes only. Information expressed does not take into account any specific situation, particular needs or objectives and should not be construed as specific advice or a recommendation. Information has been obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed. Always consult with a qualified investment, legal or tax professional before taking any action. Provident Limited does not accept any liability for any loss whatsoever arising from any use of the information broadcasted, podcasted, or published herein. All contents and information contained herein may not be copied or reproduced in whole or in part by any means without prior written consent of Provident Limited.